Welcome everybody. Today in our series of um, webinars on ISA ideas, we're turning our attention to commercial property, a traditional source of income and somewhat a diversifier from traditional equities. And I'm really pleased that we've got Bradley, one of the senior managers who looks after Schroder Real Estate Trust. Schroder Real Estate Trust has been listed for, I think, 20 years and has had a consistent record at an asset level outperforming its property benchmark with a high yield strategy. And in recent times, the company has revised its policy to incorporate sustainability, which for some investors may be a a controversial subject, but I think in property, as Bradley will discuss, is very much a mainstream activity with a pretty robust set of evidence that it can generate higher rents and better tenant retention. So it's kind of at the heart of what a lot of professional fund managers are doing, and this is a formalisation of something that the team have been looking at for some time. And in saying that, I hope I haven't completely read out one of Bradley's slides later in the presentation. Before I hand over, just some very brief housekeeping. First, if anyone does experience audio issues, if you're watching through the browser version of WebEx, then the best thing to do is to install the app. It has better audio stability and it won't take very long to install. There will be a recording of this presentation if you miss a little bit, but hopefully everyone's okay on that front. And if you have any questions, there's a Q&A box down in the bottom right-hand corner. We can see the questions you're asking, and I'll be looking at those whilst Bradley's talking. No one else can see those questions. If you have any issues, put those in the Q&A box as well. And as I said, there'll be a recording and the slides to download later as well. And with that, I'll hand over to Bradley. Over to you.
Thanks very much, Alan, and good afternoon, everybody. It's great to be here talking to you today about Schroder Real Estate Investment Trust Limited. Really nice sunny day in London today, and hopefully the sun's going to start to shine on UK real estate. With that, I'll dive straight into the first slide, and this is really a summary of why today, we think there's a really attractive investment case for SREIT. So we've got a attractive portfolio that's focused on higher growth sectors, which we'll touch on as we go through the presentation. So for example, half the portfolio is in multi-let industrial estates, where we see really interesting supply and demand dynamics, and around 13% of the portfolio is in retail warehouses, where we see a similar story, particularly with changing consumer preferences. And not only do we have those attractive sector allocations, but we've got this really high reversionary yield of 8.4%. And we'll come on to what that means in sort of pound note terms shortly. Got a really attractive dividend yield of 6.8% at the moment, based on the share price, maybe 48 hours ago. And that dividend, importantly, is fully covered by earnings. So in Q4, it was 104% covered by our earnings. Really robust balance sheet. We think it's a real competitive advantage and puts us in a really strong position when we're looking to forecast forward our earnings, because we know a very large element of our interest cost is fixed. The share price, despite some strong performance in the last year or so, we remain as a 14% discount to NAV, and we think that's an attractive entry opportunity for prospective shareholders. And that's because we're expecting a market recovery in real estate, and again we'll talk about that in some detail shortly. We think we've got earnings growth potential as a result of that high reversion. And we also have an interesting evolution in our shareholder register that's occurring at the moment. So not only are we getting new wealth managers, so we've had a couple of new wealth managers join the register in the last 12 months, we are seeing an increasing amount of our shareholder register be taken up by direct retail consumers, purchasing our shares through platforms such as Hargreaves, AJ Bell, and Interactive Investor. Finally, we have a really clear strategy. We have a thematic focus on sustainability. And as Alan says, there's some really robust empirical evidence as to how you can make an attractive return by improving the sustainability performance of buildings and subsequently increasing rents and potentially benefiting from a keener yield as well. This slide just sets out a brief snapshot of our fund for those who might not be familiar with us. So we're listed on the London Stock Exchange. You can buy our shares on all the well-known platforms. Got 38 assets, more than 300 tenants. Portfolio value around £500 million. NAV around 300 million. Net LTV are really secure, 36.6%, and strong performance in the GRESB benchmarking exercise, which is something you may have heard of. It's a research platform in real estate where they assess the sustainability features of funds and also how you manage them, importantly. We'll touch on these in more detail as we go. Brief snapshot of the fund. Now, these 6 assets that you can see represent almost 50% of the portfolio value. The first 2 assets on the left-hand side are in our multi-let industrial estates. One's is Stacey Bushes in Milton Keynes. That's our largest asset in the portfolio. We held it for a long time. Got some really interesting activity going on there at the moment, and we'll touch on that. In the bottom left, we've got Millshore Industrial Estate in Leeds. That's really close to the city centre, just like Stacey Bushes. So these really interesting urban locations where you can benefit from all sorts of occupier requirements. In the centre, we show our 2 largest office exposures. Only around 25% of the fund is in offices, and actually the majority of our offices are used as universities. So, for example, University of Law occupy our Bloomsbury office, which you can see in the centre there. That's our largest office exposure. That's a really interesting location. It's right by the Tottenham Court Road Crossrail station, and Crossrail's really transformed the geography of London. And there are public realm improvements going on as a result of Crossrail coming all around our asset. And we're seeing rents move on really strongly in the area. On the right-hand side, we show our 2 largest retail exposures. Our largest retail exposure is St John's Retail Park in Bedford. It's the dominant retail park in the scheme, a really good catchment, and that asset is anchored by Lidl, who trade really well at the scheme. In the bottom right-hand corner, you can see Headingley Central, really interesting location. You might have heard of the Otterley Run, particularly if you went to university in Leeds. I understand the Otterley Run starts here. We also brought in a Premier Inn, having converted an office, and we'll talk about some of our change of use schemes as well as we go through the presentation. But hopefully this just gives you a flavour of the sorts of assets we own and how we go about trying to earn our rents. I mentioned the balance sheet at the start. This sets out a summary of our balance sheet, and the strength of our balance sheet is really underpinned by the long-term fixed interest rate loan that we have with Canada Life. So that's 129.6 million. It's fully drawn. The interest cost is fixed at 2.5%, which is clearly extremely attractive in the current higher interest rate environment. And that has an average maturity of more than 11 years. So really secure balance sheet there. We do have an RCF. The facility size is 75 million. We've currently drawn 51 million, 51.5 million. And of that 51.5 million, 30.5 million is hedged. So there's a cap of 4.25% on SONIA, and 21 million is floating. Now, overall, that gives us an average interest cost of 3.5%, which we think is really attractive. And the average maturity, including the RCF, is 8.8 years. Just a brief note on our NAV. So we released our Q4 NAV a few weeks ago. NAV per share increased by 2.5%, and we achieved a NAV total return, so including those dividends paid, of 4%. So that's 4% NAV total return in a single quarter. And that's actually our strongest quarterly performance since June 2022. And it was actually in June 2022 where we saw that turn in real estate values following interest rate increases off the back of that high inflation that we saw coming through 2022. But it was also exacerbated by the mini budget around autumn 2022. We have been selling some smaller assets, and we do tend to find that we sell at premiums to book value. So, for example, in December, we sold a small office asset at a 23% premium to our book value. And I mentioned that fixed rate loan on the previous slide. That fixed rate loan has a fair value at the end of December of £18.4 million, and that is not reflected in the NAV because of the nature of the loan. If it was a swap or some other derivative, you would be fair valuing that asset in our balance sheet. So that's the NAV for Q4. And final point is we did increase our dividend. So the dividend to be paid in March is 2% higher than the previous quarter. And what that means is through the current sort of financial year, the last 4 dividends, they've increased by 7.3% overall. So, the new strategy, which we launched at the beginning of last year, has been paying off. And, we hope to continue raising dividends. And it's what we're working really hard to do for our shareholders. Now onto the market, and the first headline point really here is, we think this is genuinely a really interesting point for the UK real estate market. As a house, we're forecasting in each of the next 4 years a total return of 8 to 10%. That's really attractive in the context of sort of average real estate returns. Now that is made up of around 5% per annum income return, and also there's some capital growth that we expect to come through as a result of rental growths and some fairly modest yield compression. Point to note on this slide is the actuals and the forecast represent sort of an average of UK real estate. So in our portfolio, we're obviously striving to outperform this average. And for example, in the last 3 years, we've outperformed our benchmark by 4.9% per annum. Now, what's the context behind these fairly bullish returns that we're forecasting? Why do we think now is such an interesting time for UK real estate? Well, I mentioned June 2022 has been a turning point for UK real estate. And from that point, from peak to trough, we saw around a 25% decline in average UK real estate values. So what that means is, we started to see some recovery from that low level. That's why you get this higher income return, from the get-go. And we see certain sectors such as multi-let industrial and retail warehouse, which is, where we're largely invested. So 63% of the fund is invested there. We see, potential for capital growth coming through driven by that rental growth. So that brings us to the chart in the top right-hand corner. So despite that 25% fall in valuation, what's been really interesting in this cycle that's really quite different from previous cycles is that rental growth has continued to be very strong. So we're showing industrial rental growth since June 22 in the chart in green, and that's up 18%. Now you can see the blue and red lines are either pretty much flat or even negative, and that's coming out of the global financial crisis and also the 1990s downturn. So and what this really speaks to is, first of all, the structural trends driving rental growth. So that demand for industrial, online retail, changing consumer preferences, urbanization, but also that real estate income is actually a very good hedge for inflation. So when you see these periods of high inflation, rental income is actually quite closely correlated to that. And as a house, we expect inflation, to stay slightly above target for a while. So that, bodes well for rental growth as well. So we've had this valuation decline, continuing rental growth, and also what we've seen, and what we're all potentially experiencing, a rise in construction costs, particularly in the last 4 years. So construction costs have risen very strongly, and what that means is the pipeline of new development coming through is very thin, and that bodes well for existing real estate because occupiers, they're not able to go into these new developments. They have to make do with existing real estate. And not only that, but there's a real shortage of high quality ESG compliant space. And in the chart in the bottom right hand side, you can see the stats for some office markets. And the red bars show the vacancy rate of grade A space. So the kind of space that most occupiers are looking to occupy, and that's because they want to attract their staff to the office. They want lower utility bills, and they have their own corporate targets on ESG. But if we look at Edinburgh, for example, on the right-hand side, the vacancy rate is sort of 2%. Now that might as well be zero. So that means if you have an office in Edinburgh, like we do, if you're able to provide quality space, you can really push rents on. So all that comes together to lead us to believe we're in a really interesting point for UK real estate. Now, in this environment of expected strong total returns, we've got a really clear strategy as to how we believe we can deliver total returns for our shareholders. We believe that by making meaningful improvements to the sustainability performance of our assets, we can profitably push rents on and potentially bring yields in as well. In short, we believe we can profitably generate the green premium, and there's lots of empirical evidence supporting the existence of this green premium. And what's great is because we've been executing this strategy formally since the 1st of April last year, but actually quite a bit before that, we have lots of examples of where we've actually achieved this. And there's 5 in this presentation that we'll touch on shortly. And the first of those is on the right-hand side of this slide. That's Stanley Green Trading Estate in Manchester. We acquired this asset in December 2020, and it had a development site. So there's 3 acres of essentially empty land. And we got planning for 80,000 square feet of warehouse accommodation. But we made a conscious decision to spend a bit more on that accommodation to create EPC A+ space. It's also BREEAM Excellent and was operationally net zero carbon in design. And what we've seen with the new estate, so those green units, are we've been able to achieve rents that are 39% higher than the older brown units. Now, some of that higher rent will be because the units are newer, they look a bit nicer, but we believe quite a large element of that 39% is green premium. And not only have we been able to achieve these higher rents, but also our independent valuer has applied a keener yield on the new units, the green units versus the brown units. And what that means is you get more value for every unit of rent that you are earning. So as an example, we're getting around 5.2% yield on the new units versus 6.25% plus on the brown units. Now the question is, was that worthwhile? Was it worthwhile spending extra to get these really high quality units, very sustainable, in order to get higher rents? And the answer is on the slide. It absolutely is, because since we've owned the asset, we've made a total return per annum of 17.3%, and that compares very favorably to the all industrial benchmark of 8.3% per annum. Now, us doing this, it sounds very easy, but we've only been able to do this because we have a really strong sustainability team that's dedicated to real estate. So we have subject matter experts in various aspects of real estate, such as net zero, climate, impact, data, and we're able to draw on their expertise when we're designing these schemes. A couple more examples. On the left-hand side is one of our retail warehouse assets. This is Churchill Way West Retail Park in Salisbury. We recently took 2 units back for development, so they were occupied by Smith Toys and HomeSense. We've agreed a lease with Lidl to bring them to the scheme. And what we've been able to do is increase the rent on a per square foot basis by 67%. Now, how did we manage to do that? Well, we are spending £1.5 million to create a unit and space that's suitable for Lidl. In particular, it has to be EPC A. So for example, we're putting PVs on the roof, EV chargers in the car park, fully electric HVAC systems that are far more efficient and can also take advantage of the green of the electricity grid. And not only is the rent much higher, but the lease is 25 years with a break at year 20, and Lidl are a fantastic covenant, really strong business. And the question again is, was it worthwhile spending that £1.5 million to get the higher rent? Well, the income yield on cost for us is 12% for this project, so we think it's very much accretive. On the right hand side is one of our multi-let industrial estates. This is Stirling Court in Swindon. We undertook an extensive refurbishment of 2 units there, moving the EPCs on from a C and a D to a B for both of them. We'd let one already at a 32% increase to the previous passing rent, and the second is under offer at a 41% increase to the previous passing rent. And the income return, or the income yield on cost there, is around 10%, So again, very attractive. And by the way, the income return on cost, of course, ignores the potential of capital growth as well. A couple more examples. On the left-hand side is Holling Lane, which is part of Stacey Bush's industrial estate in Milton Keynes. So this is part of our largest asset. And the great thing about the multi-let industrial estates is you can make improvements sort of piece by piece and keep the income flowing through other parts of the asset. And what we had here was a old unit. It was 4,900 square feet. It was dilapidated, not up to ESG standards, and was also very low site cover. So we dropped that and developed a 17,000 square foot modern unit. So this is also EPCA plus, BREEAM excellent, operational net zero carbon in design. So similar to Stanley Green development. And this is under offer now to an international EV manufacturer, and not the one in America. And the rent there is 42% ahead of the estate ERV. So it's interesting. It's similar to that 39% that we saw at Stanley Green, but it just shows if you do have that quality space, you can get higher rents. And not only are we getting higher rents, but you're also getting stronger tenants. So, this EV manufacturer is a great tenant covenant. At Stanley Green, we've got Siemens in one of the units, for example. So, global conglomerate. Now, on the right-hand side, briefly, is an office asset. We're in the process of undertaking a comprehensive refurbishment of the common areas, so the ground floor, the basement, and the other common areas in the asset. We're adding lots of sustainability sort of upgrades, so electric HVAC systems again, improving the glazing, adding meeting rooms, well-being space. There's a studio as well, end of journey facilities. And what all that means is we can move the rents on. So we've taken the 5th floor back as well. We are refurbing it to Cat A, and we are targeting a rent that's 74% higher than the previous passing rent. So it shows you can do this profitably. And again, is this going to be profitable for us? Well, we're forecasting an IRR over the next 5 years of 13% per annum. Onto the portfolio. Now, we spoke about some individual assets and how we're applying the strategy. So that sustainability improvement strategy to those assets. But there are other, elements of the strategy, and we do look top down too. So we have a research-led approach that drives our sector allocations. And you can see on the right-hand side, our sector allocations, we're overweight industrial and overweight retail warehouse, which is where we see good potential for rental growth. We also have a very granular portfolio. We've got 38 properties and more than 300 tenants, which means that risk is spread. And we think that makes our portfolio more resilient. We also have a really attractive income profile. So our net initial yield is 5.6%, and it would be 6.1%, but one of our tenants, so our largest tenant, is on a rent-free until October. And when that ends, the yield, all else being equal, will jump back up to 6.1%. And the reversion yield is 8.4%. Now, to put that reversion yield into some context, because these yields can be a bit abstract, so our annual rent is £28.5 million per annum. And that reflects the net initial yield of 5.6%. The estimated rental value, which is the market level of rent that the value I think we could achieve if we let all of our units today on market terms, is £39.6 million. So that's more than £10 million ahead of our current annual rent. Now, that £10 million is really material in the context of our dividend. Our annual dividend is currently just over £17 million. So you can see if we can capture some of that reversion, let alone all of it, that puts us in a really good position to be able to push on that dividend in the future. Another thing that investors often look at, and rightly, is the tenant lineup. And these are our 15 largest tenants. They represent almost a third of the passing rent. And we think we've got a really strong tenant lineup. The first thing I'd point out is there's only 2 tenants that currently, or at the end of December, represent more than 3% of passing rent. So that again speaks to that granularity and that spread of risk. And when we look down this list, we see household names such as Siemens, Lidl, Balfour Beatty, Premier Inn, and we feel really comfortable with this list of our largest tenants. I mentioned that reversion, so it's more than £10 million of rent. And here we show some steps as to how we could get there. In our leases, we have fixed uplifts, and that's usually the end of rent-free periods. And since the end of December, we've already benefited from £800,000 of fixed uplifts in our leases. We've got a further £4.7 million of fixed uplifts to go before the end of next year. And half of that relates to the University of Law, which I mentioned before. So 2.36 million. They're on a rent-free period until October, and then they'll start paying us cash rent. At Stanley Green, so I mentioned that development of 11 units. 10 of them, as at today, are either are let or have an AFL, agreement for lease, in place. There's only one unit that remains vacant now. We're working hard to let that, and that'll bring in another sort of £200,000 of rent. And then as we get rent reviews coming round and lease renewals, we should be able to capture that ERV, so that excess ERV on units where the passing level of rent today is below the market level. And we have some vacant space as well. So including Stanley Green, the vacant space is 4.6 million, which leads us to the next slide, which shows a breakdown of that vacancy. Now, importantly, of that vacancy, when we released our NAV, we noted that 3.6% of the 11.6% is either let or under offer. And there's a breakdown of that on the slide here. So when we look at our void, we actually see an opportunity at the moment because it is high at 11.6%. And it's been at that level for around 18 months. And in that time, we've been able to move that dividend on materially, as we looked at earlier on. And, we do expect some void in the portfolio because of the nature of our strategy. We want to be undertaking refurbishments. We want to be pushing rents on, which means you need space back to relet it sometimes. So hopefully what we'll do is bring the void down from 11.6 to 8.5%, which is where we probably target. And then that will give us a one-off boost in income. So final slide from me. As I said, we think it's a really interesting time in the real estate cycle. In the UK, we see values recovering, slowly, but still recovering. And as I said, that's supported by limited development, continuing rental growth, and also we could all benefit from any further interest rate cuts. We're delivering strong relative outperformance, and we see significant potential to drive earnings growth for that high reversion, our active management approach, and also that really strong balance sheet. And we think we've got a really clear strategy that hopefully, following today's presentation, you understand a bit more clearly. With that, I'll hand back to Alan. I think you're on mute, Alan.
Is that better?
Yeah, got you.
Yeah, sorry about that. So there's a kind of fundamental question one of our viewers has asked, and I think you've covered some of the points across the presentation, but perhaps bring it together. What they're saying is that a lot of retailers and other businesses are seeing increased costs. They're trying to cut costs, and so why are you so bullish on commercial property? And I think you've hinted at some of the answers, but you just want to sort of package that up into a couple of paragraphs.
Yeah, I think the right concerns. We are seeing more particularly smaller businesses struggling with higher, some higher taxes, slow economic growth, high cost of living, all those elements. And I think what we're trying to do is we're targeting multi-let industrial estates where there's a real diversity of business types that use the space. So it's warehousing, it's trade, it's logistics, gyms, there's all manufacturing. So you kind of get this real diversification. And also, they tend to be less sensitive to staff costs. And where I am more positive on the retail side is very specific in retail warehouses, which have really benefited from changing consumer preferences over the last few years. And in addition, yeah, I mean, they're just we're really focusing not just on retail warehouses, but convenience. So we're trying to avoid, fashion led or, that sort of retail warehouse. We're looking for retail warehouses where rents have been rebased historically. Um, you got anchor tenants like Lidl or bulky goods like Wix, where people will drive there very conveniently, pick up some goods, probably spend quite a bit of money every time they go, and drive home. Um, Rather than going into, sadly, town centres now and shopping centres, etc., which just feel like a lot more effort. Um, so yeah, fortunately, we're not overly exposed to the kind of retailers and leisure and food and beverage where you are seeing these really acute issues with higher costs of business.
Yeah, and do you have a sense of a kind of energy cost difference? Because obviously that is front and center of rising costs, isn't it? And you're offering more energy efficient buildings. So presumably that comes into the equation when a tenant's looking at their overall costs.
Yeah, absolutely. And um, I think it's why, this environmental sort of improvement approach is a lot more tangible for real estate because you can see these cost savings. But the unfortunate thing is there's not sort of a very specific rule of thumb you can apply. It's very case specific, asset by asset, as to what you can achieve. But clearly, with the UK's got very high energy costs, so it is one of the reasons why you can benefit from this green premium. It's because tenants can basically save over here to pay a bit more rent, as well as achieving their own corporate targets. And many of our companies now do have these corporate targets, and I think it's right that they do.
Mm, mm. And in mentioning case by case, there's another question asking about managing properties and a related question about costs of running the fund. So do you just want to talk a little bit about what the kind of layers of asset management and property management are and how you approach making a business plan for each asset over its life, just to kind of bring to life the day to day of how the fund runs.
Absolutely. So if I start kind of at a pretty high level in terms of the ongoing costs of the fund, um, investment trusts have been pretty unfairly treated in terms of releasing costs. And I can see someone's quoted our ongoing costs at 4.7%. But, the reality is if somebody buys the stock, all of the costs are reflected in that share price and in the dividend yield, etc. There's no sort of beyond what you might pay to the platform to buy the stock, there's no additional costs. So if I was to think about what costs a investor might be interested in at the highest level is, the investment management fee, which is 90 basis points. That is in line with all of our peers. Um, and then there are just some ongoing fund costs like, there's directors' fees, audit fee, company secretary fee, etc. And if you take all those together and what we'll be disclosing in our KID shortly, which we're trying to get out ASAP, is 1.2% ongoing cost. But then I'll just emphasize that that's not in addition to anything that's not already reflected in the share price and in the net asset value. Unfortunately, the FCA have released some forbearance and some guidance. They're out with a consultation at the moment to formalise the change in cost disclosure for investment trusts, which I think have been unfairly treated relative to other investment vehicle options. So hopefully that just helps people understand the cost of investment trusts a bit better. Then in terms of what we do, so within that management fee that we receive, we provide, you portfolio sort of structuring and sector allocations, asset management, sustainability, finance. We do the annual report, etc. We are out marketing the fund to new investors, and Schroders will pay for advertising and pay to appear at events, and all that's beneficial, hopefully, for shareholders because it should drive demand for the shares. And then at the when we're out there looking to buy an asset or thinking about a business plan, what's great with this fund, within that management fee I mentioned, you get the benefit of the whole of Schroder's real estate platform. So Schroder's in the UK manages 11.9 billion of assets. So we see a lot of the market. We can see where rents are going. We understand the costs of refurbs and construction, etc., quite well. We've got teams on the ground in London and Manchester who are looking from, I guess, the drains up, the bottom up, so that very granular level at the asset level. And we have research teams who are looking top down, looking at that macro picture, thinking about bigger things that can affect, the demand for industrial space versus retail space. Then we can put them together to create our forecasts. Then every one of our assets has an asset manager assigned to it, and they are sector specialists. So we've got a retail team, an industrial team, hotels team, office team, and so I benefit from the input from those really experienced people who are experts in their fields. So when we're underwriting an acquisition or a business plan for an asset, I think we get really good intel in terms of where we think the rents are going to go, what the cost of capex will be to improve assets, where the rents might go post capex, how the sustainability performance of a building could improve or be improved. I benefit from this huge platform in Schroders, which I think is actually probably underestimated and is probably a differentiator versus many other options that you have in investment trusts or just investment sort of real estate companies. And we do business plans once per annum. So every year we're looking again, should we keep this asset? Should we be investing in this asset? Should we sell it? And hopefully it's come across in the presentation. We have a very active approach. We're looking to take on property risk, to sort of undertake work ourselves to get higher rents, to create better assets, a more liquid and resilient portfolio. We're not just relying on buying and holding, collecting rents and hoping yields move in. Hope that covers the question there.
Yeah, and it's particularly stark, isn't it? This cost disclosure thing for real estate trust like you, because there are a separate category of REIT that isn't caught by this, that has all the same costs but doesn't have to disclose them. So it's a particularly clear example of the nonsense of it, isn't it?
Yeah, and thankfully there is progress being made on
Yeah.
the disclosure requirements.
Yeah. Do you just want to? There's a question about how yields and investment and your kind of return. I guess it's about assessing a return on investing in a property. Obviously, if you're doing something substantial to property, it's going to be void. So how? And you mentioned some of the IRRs, but do you just want to talk through sort of timeline of how you'd approach refurbishing or upgrading a building where there's a void, and how you weigh up the upside versus the loss of rent?
Yeah, absolutely. I think probably something we always have in mind is we have to pay this dividend to our investors. Many investors own us for income. That's not to say we're turning capital into income. We still focus on total return, but we have to deliver this dividend. So the dividend yield is around 7%, perhaps, around 7%. So when we're thinking about the overall portfolio, we want to pay a fully covered dividend. So we're thinking we need to be getting this sort of 7% yield post benefit of leverage. And that's really the anchor that we're looking for. And of course, if we can do better, great. Then it means we can push the dividend on, and then hopefully the share price increases. So that's, I guess, the kind of anchor in the back of our mind, what we're trying to achieve here. So then across the whole portfolio, it gives you, options to there are some assets where, you've done the work and you therefore collect the income and that pays the dividend. And then there are opportunities for capex or major refurbishments. And what's great is you can always sort of select the most accretive one at any given point in time. So as I said, we kind of do a detailed assessment of every asset once a year. And that's when we get the capex into the business plan, and that gets signed off by the investment committee, which is chaired by Nick, who's co-manager of the fund. So you get real expertise looking at the plans and sort of scrutinizing those plans, and it keeps us on our toes basically, and means that we are allocating capital appropriately. So we then, as part of that process, we forecast the fund forward. We forecast the fund forward every quarter, actually, in terms of cash flows. So you can see, okay, if I do these projects, as you say, that means I'm going to stop getting rent from those units or that asset. Can I still pay my dividend? Or is there a better use for that capital? So, for example, in the past, we have done share buybacks at a time when the discount was around 50%, and they were extremely accretive. So yeah, it really is about keeping that dividend paid and allocating capital to the most accretive uses. So yeah, I think that's how we look at it.
Mhm. And finally, that I mean the almost 30% share price rise over the last year tells you that people are less worried about this generally in property now. But part of the reason why REITs as a sector saw share price falls was related to debt finance and not on top of worries about property values, but debt finance, ability to refinance, higher interest rates, and of course that's all eased off now. The trust's balance sheet is in pretty good shape. Do you just want to do you want to walk us through your financing and how that works in terms of security against different assets? Gearing's are obviously a topic of great interest to all investment trust investors. So it's good to understand some of the finer points of a REIT like yours.
Absolutely. So our net LTV, which is the main measure that we sort of look at for the fund ourselves, is 36.6%, which is a very comfortable level. And back before the GFC, gearing was far higher than that. So I think that we all sort of learned a lesson out of that, and we have kept our gearing at a much, real estate in general, that is, have kept gearing at a much more manageable level. We are very fortunate to have that long-term loan with Canada Life, and probably a bit of luck, bit of judgment. We undertook a refinancing in 2019 to lock in that 2.5%, and it cost us money at the time to do that, but it's clearly paying off in the current interest rate environment. And it's really important to look forward because, of course, we had that one-off cost in 2019. So if you looked at our performance in 2019, you might think, what happened? Well, we essentially made an investment in our debt, and it's for any shareholder coming in now, they benefit from that for the next 11 years on average. And that Canada Life loan is secured against a sort of sub portfolio of our assets, and we have covenants in place with Canada Life. We report on them in our annual report and our interim report. We've got really good cover on all those covenants. So again, I guess it's almost another control mechanism that keeps us on our toes and keeps us focused on risk management and that side of thing. Similar story, the RCF. We have a smaller portfolio secured against the RCF. It's a smaller loan. We also have some covenants on the RCF, which we report on to the bank every quarter, and we report to the market in our annual report and half-year report. Again, really good cover on all of those covenants. And there are certainly some of our peers that are probably feeling a bit uncomfortable about some refinancings coming up in the next three years or so. And we're very fortunate that we don't have to worry about that. We can focus on the top line, moving rents on, and therefore, hopefully continuing to push that dividend on as we have done over the last few years.
yeah, that's a really good description of that. And so with that, I'll just conclude by reminding everyone that despite the share price rise that I alluded to, the trust is still yielding over 6% at the share price, and it is striking when you look back over report and accounts across this little period of uncertainty for property, how at an operational level the trust has carried on growing its rent. So if anyone has any wants to delve a bit deeper, Schroder's website has a wealth of information. If anyone's dying to find out what an ERV is, I'm sure there's a glossary in the report and accounts to tell you how it's calculated. And equally, Kepler's website has plenty of information on this trust and others as well. As I said at the beginning, there'll be a recording up shortly if you want to go back and look at anything, and the slides will also be available for download. So Bradley, thanks so much. Look forward to seeing you again soon, and to everyone else, we'll see you on the next one.
Thanks very much, Alan.